And joining me now with more this morning is Keith Fitzgerald, principal at the Fitzgerald Group. Keith, great to have you on this morning, joining us from Seattle, bright and early over there in 2026. What is on your radar as this new year begins?
Well, I'm actually coming in very excited. So happy New Year. Let's get this one off to a great start. I think we've got some great bullish inputs in the market. The Fed is dovish in the wings. We've got trillions of dollars still looking for a home. The AI trade is just early innings, and many of the great names continue to put up double-digit earnings. So I think all told, if investors pick carefully, they're going to have one heck of a year.
Does this AI space look attractive to you? After some profit taking to end 2025, we do see renewed optimism in those trades this morning.
Yes, it does. Now, to be clear, I'm expecting some substantial chop because there's still a lot of skepticism, right? Skepticism is always an opportunity. So that's something I welcome personally, even though it's scary to a lot of investors. But I think the AI trade, if this were a baseball game, is so early innings that the hot dog vendors aren't even warmed up yet, Kristen.
Interesting. So, Keith, are there specific names that stand out to you as we start this new year?
Yeah, I'm taking a look at some of the winners that I've been with for a while because my attitude is when you're on a winning horse, you don't switch in the middle of the race. I think Raytheon, with regard to defense and AI, particularly hypersonics, you've got autonomous vehicles, you've got defense, all of which keep our warfighters safe and the world a calmer place. The other thing I'm looking for is Palantir again. I want it to reclaim 200. I think that stock is going to rocket sharply higher by the tail end of this year. And then finally, I want to balance all that out with a company like Walmart, which is all about the consumer, but it's really an AI company that happens to be in the retail space.
You know, it's interesting, Keith, because market watchers are anticipating one rate cut in 2026 after we saw three back-to-back cuts in these Fed minutes to end, of course, 2025. What does that mean for equities?
Well, historically, the linkage has been good. The inference is lower rates, cheaper money, bigger expansion. But, you know, the problem with that, in my opinion, and I have a controversial opinion on this, is that I don't believe the Fed knows what it's doing. I don't believe the Fed knows anything proactive. It's playing with busted models that don't reflect the economy of today. So, all that said, you know, I'm looking more for businesses that can survive no matter what the Fed does next. I'm not smart enough to figure out whether they're going to cut or not because every model they've got, I don't think applies. So I think I'm going to bank on cheaper money, but it's not going to be the Fed that gets us there. It's going to be companies that are going to rise into the occasion.
Okay, so how much can we see the S&P 500 rise in 2026?
Believe it or not, I think we're going to see some positive stuff. Second half, much more conservative, but I think 7,500 plus by the end of the year. So 9.5%, 10% is where I'm looking. That may, you know, obviously that's still first day of the year, so I may have to, revise that number. But I'm looking positive. I'm looking strong. I think that the markets are going to carry the day.
Mm-hmm. You know, it's interesting because suddenly in the past week or so, Keith, precious metals have returned to the spotlight. We've seen some volatility, but certainly silver up triple digits in 2025, gold up double digits, and gold was a big narrative throughout last year. Are you watching the precious metal space?
Very carefully, but not for reasons that people might think. You know, I remember the period, I'm old enough now, I remember the period 79, 82, where gold rose under very similar circumstances. So did many of the metals complexes. By 1982, they'd fallen by half. So I look at this, I'm extremely skeptical. I think it's great that it's going up. I laud everybody who owns it, but I worry that the liquidity is increasing at a time where the leverage is jumping off the charts. So that's not a trade I'm keen to run into at the moment.
Interesting. Yields in focus as well. They were rising this morning too. What does that signify?
Well, historically, for the very traders I've just mentioned, the high speed, go fast, highly leveraged traders, that means more expensive money. So traditionally they sell off. So I'll be curious to see how the rest of the day plays out, even though we've got an early bid.
Okay. What else is on your radar, Keith, as we look to begin this new year?
Well, I'm looking for smiles, I'm looking for earnings, I'm looking for competent CEOs because, again, I think that many of the great themes that we followed for the last decade are beginning to accelerate in earnest. This is very different than anything we've ever seen in the United States or in the world for that matter. So positive companies, positive earnings, stick to your knitting, best horses in the race is where I'm going to focus this year.
I know you referenced a bit of a conservative view that you have in the second half of the year. To what extent does that factor in the midterm elections, which will get, of course, in November of 2026?
Well, again, my research is very controversial. I don't see politics. I do money. because money is the influence that is going to drive the markets. As much as everybody thinks it's politics, my research shows definitively that the markets are going to move regardless of whether it's Republican or Democrat. So what I want to see is politicians get their act together. This is an American issue, not a right or a left issue.
Mm-hmm. Now, even though we saw a 16% gain on the S&P 500 in 2025, volatility was present. Are you expecting a smooth rise to a 10% gain by year end, or could we see volatility along the way? And what would spur that?
No, I don't think we're going to. I think, as a matter of fact, we're going to see more chop than many investors are used to. And the reason for that is that time is compressing. We're seeing all the volatility we used to in years past, but it's just happening faster as the markets have become more and more computerized. So the first half of the year, to me, is going to be the rocky part. The second half is things are going to settle down. Traders are going to get a more of a directional input.
All right, Keith Fitzgerald joining us early this morning from Seattle. He's principal of the Fitzgerald Group. Keith, Happy New Year.
Likewise, Happy New Year. Thank you.
Thank you.